All right, everyone. I wanted to take a little bit of time talking about some of the problems in here. Some of them, mm, to me are a little bit more straightforward than others, and I want to spend the time on the ones that historically create the most challenge for students working them on their own. So example one is all about bank recs, and it gives you three different bank rec scenarios, really in order probably of increasing difficulty. Each one of these, I think, with the notes that you have, as well as the additional face-to-face lecture pieces I gave in the cash and cash equivalents bank recs handout, I think those will largely help you in dealing with these pieces. The same story with example two, which gives you a couple of examples of just classifying cash and cash equivalents and dropping them in the appropriate buckets. Okay, so both definitely could be problems on an exam, and don't tend to be the problems that give students issues. Now, example three goes into um, cash discounts on credit sales. And, we really haven't had a moment to apply this deeply and to kind of, apply the ideas behind cash discounts. So I wanted to step through these just a little bit. So we have a company, Mason Field, and they sold 25,000 units of inventory during a quarter. Each unit cost them five, was sold for 12. So, of course, keeping our cost data separate from our sales data is very important. We need to know what to drop into cost of goods sold and what our inventory is going to be valued at. So that's really given to us by this piece. And then, of course, we need to know the sales price that I'm setting and the amount of receivables. So that's going to really affect my accounts receivable and my sales revenue that I recognize principally. Okay. They have discount terms, 3% if paid within 10 days. Otherwise, the full amount's due in 45. And let's assume that the customers paid for 17,000 units during the period and 8,000 units outside the period. So we're going to provide journal entries for the sale as well as the payments that our customers make. So the payments I'm referring to are customer payments that are settling out their accounts with my company. So first with the gross method and then with the net method. So with the gross method, on the point of sale, we sold 15,000 in total. And remember, the gross method assumes full price because the idea behind the gross method is we record the sale as if the customers are not going to take a discount and therefore pay full price for these items. They're being sold at 12 each, and we sold, sorry, not 15, 25,000. So we have 25,000 units sold for $12 each. And we keep it at $12 because we're using the gross method. So when you have that, that gives us $300,000 altogether. So I debit accounts receivable, credit sales revenue. Understand that whenever we have terms, discount terms like this, that means we're doing this deal on credit. And if we're making the sell, then that means we're recording, of course, accounts receivable, debiting accounts receivable because now people owe us money, our customers, and we can record the sales revenue because we've provided the product that goes along with that. And those two together came up to $300,000. So that's the amount that I can record here at full price. Now, remember, the net method is different in that its initial assumption is everyone's going to take a discount. So we have the 25,000 units still, but we're going to use a discounted price. And so that discounted price is the $12, but we apply a 3% discount. So if I multiply that by 97%, that does the same thing. So 12 times 0.97 is $11.64. And we multiply that by 25,000 and we get 291,000, which is the same amount I would get if I had applied 97% to 300,000, right? We're just taking 3% off this entire amount. I do want to cover real quick, same accounts, by the way, just different amounts. So the choice between gross and net method doesn't change the accounts we use at the sale. Later on, it can change the accounts that are available, and we'll talk a little bit about that. But at the point of sale, the accounts don't change, just whether I record the sale at its full amount or its discounted amount. One thing I do want to address is netting because I don't know in the curriculum in the university curriculum's idea, they want you to take advanced math and then still not really understand the idea of applying percentages, which is not a good thing. So um, you could do this two ways, right? You could take 12%, multiply it by 3%. That gives you the discount, but then you have to go and subtract it from 12 again. So basically, what that boils down to is $12 and then $12 times 3%, which comes out to 36 cents. And then you subtract it from 12 and you get 11.64. So the idea is rather than doing this sort of two-step process where you apply the discount to our full amount and then subtract that from the full amount, you can just recognize that if the full price is $12, right, I take 3% off of that, then that we've already discovered is 36 cents. But the more direct way of solving for the after discount amount or the net of discount amount is by multiplying 12 by what's left over after I take 3% off, which is 97%. And I just want to make sure the math is clear here, so that when we start talking about taxes and net of tax, that you can use a similar convention to just cut down on the arithmetic that you need to use to get to the net of tax answer. In this case, we're cutting down on the arithmetic to get to the net of discount answer. Um, Now, if I'm at a discounted price and I want to gross it up to 12%, the most common response people will give on average is multiply this by 3% and add it. That's not going to get you 12 though. In order to get 12, you have to think of precisely what we did mathematically to get from 12 to 11.64. In this case, we took $12, multiplied it by 97% or 0.97, and that gave me 11.64. So if I'm looking for what the full price is, and that's my unknown, and I have a discount that has already been applied and lands me at 11.64, well, then the way to solve for X is to divide my after discount amount by the after discount percentage that it represents. And that will give me $12. So basically, I'm just undoing the multiplication. I'm inversing the operation. 12 times 97% is 11.64. Well, then to get back to 12, I have to take 11.64 divided by 97% to get 12. And it's all based on this idea of using the net of discount rate. Okay. So that's just a little side note on expediting your math in this proportion. So notice again, we have different amounts recorded. And the difference in the amounts, just to refresh, is due to us taking the discount out when we record our accounts receivable and our sales revenue. Here we don't under the gross method. So I'm going to follow the gross method the rest of the way through. It said that they paid for 17,000 of these units during the discount and 8,000 outside the period. So if we're within discount, then it's going to look something like this. If we have 17,000 that we paid for inside discount, then if we paid within the discount, if we're calculating the amount of cash that was paid, it's always whether we paid in the discount or not. So within the discount, that means $17,000, 17,000 units were paid for at a price of $12, but they paid within the discount. So we apply 97% to that $12, and then we can get our final answer. So 17,000 times 1164, which is our net of discount price, gives me $197,880. Okay, this is the cash paid. So as the company, I record that cash receipt as I'm collecting receivables from my customers. And that's something really to remember is that when I'm dealing with cash discounts on credit sales, this is always going to basically bake itself into my credit sale itself and also any collections made on those discounted credit sales. So I am principally debiting cash and crediting receivable, and I'm leaving myself some room because we have a third player that is going to step in here. So I got this much cash, $197,000. Now, how much do I credit accounts receivable for? And before you jump, think about it. Well, how did I record accounts receivable when the sale was made? I have to apply the same logic. Here, I recorded them at their gross value because we're under the gross method. Remember that gross method affects the receivable account and the sales revenue account. So I'm going to have to continue using the gross method as I solve for receivables, which means that rather than apply this discounted amount, the receivables should be equal to all of the units that were paid for, but at their full price. We recorded them at their full price. We have to get rid of them at their full price. So 17,000 and the full price per unit of 204,000. I'm sorry, full of $12 gives me 204,000, right? The third account needs to enter in as a debit because right now we're imbalanced. Why are we imbalanced? We're imbalanced because our customers paid us within a discount, which means they recorded, I'm sorry, they had to pay less cash than the value of their accounts with my company. Why did they pay less cash than the value of accounts within our company? Because they paid in the discount window and we recorded those accounts under the gross or full price method. So that's why we have this differential between cash and receivables, and that gets settled out by a sales discount account. So remember, this account is a contra revenue account and it reduces my revenue. Why do I need to reduce revenues? Because I recorded a full $300,000 of sales revenue. That would be an overstatement unless I acknowledge that some of my customers did not actually end up paying the full amount for their receivables. They took a discount, which reduced the amount that I can truly claim as revenue as the deal settles. Cash is, of course, assets going up, and accounts receivable credit is assets going down. So now for the remainder of the units, they paid outside the discount. They get no discount terms. Since it's outside the discount, those last 8,000 units that were paid for are going to be at full price in cash terms. So it's 8,000 times 12, and that's 96,000. So the question becomes, how much do I record for accounts receivable? Well, I'm using the gross method, so my accounts receivable is being valued at its full price amount. And so I can use the very same algebra or arithmetic here to get the amount of receivables I settle out. And that, of course, is just an asset for an asset. We are just converting our accounts receivable to cash. So notice the accounting works as planned. If we just consider this piece in isolation, the amount of sales revenue I ultimately record equals the amount of cash that I ultimately received. So if we look at the cash, what happened to our cash over time with this transaction? We got 197,880. We got 96,000. And so all together, I got 293,880. And now let's look at the amount of, oops, sorry, that wasn't on the screen there. So I just added the two pieces of cash here and here together to get the total cash involved in these transactions. And now we're going to go with sales revenue. Sales revenue started at 300,000, was reduced by 6,120, and no sales revenue issues going on here. Which gives me precisely $293,880 of revenue. And over a long enough haul in accrual systems, if we look at a long enough time horizon, say, I don't know, 3 quarters for some companies, maybe 3 years for others, the amount of cash inflow should be equal to the total revenues recognized over a long enough period. And the same is true with expenses. The amount of cash outflow should equal the total expenses recognized over that period. So we're checking out well here. Let's talk about the net method then. So with the net method, remember, those discounts are already taken out because we basically assume everyone's going to take that discount. And when they do pay within the discount, well, then we're not surprised because that's how we set up our credit sale record, right? We already netted those things out. So, yes, they're still paying within the discount. It's the same amount of units, it's the same discounted price, the same amount of cash. One thing that you can take with you in any financial reporting course is that cash is constant over accounting systems, over accounting methods. So cash will be the same amount recorded in and out under IFRS, under Japan GAAP, under anything, right? Even within certain accounting regimes like US GAAP, cash does not change regardless of gross or net method or any of our distinctions, LIFO versus FIFO. Cash always remains an economic truth. Right? So if we got that much cash, now what about those receivables? Well, the receivables are no longer being valued at their gross price, they're being valued at their net of discount price. And so it becomes the same math, 17,000 with an after discount amount on the $12 price. That's going to be my accounts receivable for the same amount here as the cash. There's no surprise, there's no third account necessary because they acted within the bounds of how we recorded and valued my receivables and my sales revenue under the net method. However, when they pay outside the discount window, we have a little bit of friction because the amount of cash that we record will be the same here. However, our receivables, because we're operating under the net method, are being recorded at a net of discount price. So we have to record the receivable at that net of discount price. Give yourself a little bit of room to insert a a third account in here. And we have $8,000 of accounts that are being paid, but that $12 is discounted in my receivables account for this company because of the net method employment. And so that's going to change our amount of receivables that are settled due to this. And it'll bring it down to 93,120. Well, now we need a credit to fill this discrepancy between cash and accounts receivable. The credit that we're going to need is to sales discounts, not sales discounts, period, but sales discounts forfeited. Okay, because my customers gave up, they forfeited a discount. So in this case, then the missing amount would be 2,880. Remember, the sales discounts forfeited is a little different, very different, in fact, than the sales discount. This is a contra revenue account, and this is just non-operating income. So sometimes in some companies, it'll actually be called interest revenue, which really highlights its function as non-operating income. On the income statement. Sales discounts on the income statement, we deduct them. We deduct sales discounts directly from sales revenue. So rather than even seeing $300,000 reported as sales revenue on an income statement, we would see that. We would see sales revenue net and that amount being listed at $293,880. Okay. Alternatively, in this scenario, we would see sales revenue net 291. We still include the word net because this sales revenue is net of discounts. It just happens to be net of discounts for every single sale I made versus this number is just net of discounts for those who paid within the discount. Right. And then where does sales discounts forfeited come in? Remember, in terms of the rough format of an income statement, you have COGS next. You would subtract that off. You would get gross profit after you subtracted off cost of goods sold. Then you would have your operating expenses, and that would take care of things like bad debt expense, depreciation, amortization, all of that, paying your employees, paying your utilities, paying your rent, all the recurring expenses of the business model. That's operating income. And then finally, you would have non-operating items. This is where your interest revenue or your sales discounts forfeited would come in and add to the balance. And notice what it's correcting for is the fact that on this top line, I overestimated the people that would pay within the discount because I said, hey, we're using the net method. 100% of our customers are going to pay outside the discount. I'm sorry, are going, sorry, 100% of our customers are going to pay within, not outside, within the discount. And so it discounted our revenue for the entirety, for the entire amount, as if every unit was paid for in the discount. Well, since some units, 8,000, were not paid for in the discount, we have to add some of that revenue back. Notice that if I ignore everything else between, I only get to the amount of sales revenue net reported under the gross method after I get all the way down here to pre-tax income. Right? Assuming that all COGS, gross profit, operating expenses, operating income were equal for these two companies, the only time that my amount is adjusted appropriately and will become the amount that I reported under the gross method on the top line, right? Because this is our top line. It would be COGS to gross profit, et cetera, all the way down to pre-tax is when I get into my non-operating income. So that's the difference. These two methods will report different gross profits, different operating income. They only come together and report similar stuff beginning at pre-tax income. All right, so that pretty much describes all of the pieces of the gross and net method. Understand that the sales discount account is contract, it's a contra revenue account, and we deduct from sales revenue, or sorry, deduct the sales discount directly from sales revenue because it is a contra revenue. This one, on the other hand, is a non-operating income item, so it goes all the way down here in sales discounts forfeited. Sales discounts forfeited are only recorded under the net method. Sales discounts are only recorded under the gross method. And I believe that's about it. If you have any questions about this, of course, always send me an email.